You got to look at it, I think, more on a somewhat of a permanent change. It's almost like the way 9/11 changed flying, forever. I think this is going to change the way people look at energy long term.
John Zechner is not afraid to be contrarian. The veteran investor tells us why he thinks energy investors are being way too complacent and why he's not afraid to buy beaten up software names.
I have not been an Oracle fan, but then the stock has just been hammered. You look at it. Adobe, what are we? 10, 11 times forward earnings. Salesforce, 12 times. Workday, ServiceNow.
I mean, are you brave enough to go there?
Oh, absolutely.
But he's staying away from the financial sector.
Right now, I've got almost no bank exposure on either side of the border.
Why aren't we seeing a rip-your-face-off rally in energy stocks? Would you look at the stock after they cut the dividend? When you picked Maple Leaf Foods, it was languishing at the lowest level.
You and Francis gave me a pretty hard time on that.
I went back.
We were talking about the vegan food and all.
You're like, it's fine.
Yeah, I still eat steak and all of that.
When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss Constellation Software, Fairfax, and TELUS, which are all stocks that I own. Hey everyone, welcome to another episode of In the Money with Amber Kanwar. Today we've got John Zechner on the show of Zechner Associates. I love speaking to him because he helps the markets make sense. And right now, it's a little bit of a head scratcher. We were actually just talking about it. So it seems like the war with Iran is getting worse. The U.S. now says, forget Iran blocking the Strait of Hormuz. We're going to block the Strait of Hormuz to try and wrestle control of it. Peace talks break down. And what's the market's first reaction? To rally. And what's interesting is that since the low, the market put in a low on March 30th. Since that low, do you know what's done well? Not energy, even though energy prices presumably would benefit from a blockade here. It's been this instinct to go back to tech, to go back to software even, dare I say. So for the past year, we've had guests come on the show say, you don't own enough commodities, you don't own enough commodities. And that has served investors really well. We have a conversation with John Zechner about whether we're in for a little bit of a turning point. The fact that commodities have underperformed after the market bottomed. Are investors now willing to go back to tech because it's cheaper? Some of the chief complaints have gone away. It was expensive, now it's cheaper. It makes up too much of the market. Well, since the stocks are under pressure, it doesn't make up as much of the market. And as we get into earnings season, there's still expected to be the big earnings growth drivers. And as we saw from last year, earnings growth kind of trumps everything. So it's another great episode of separating headlines, what makes headlines from what makes money. And I think this is a kind of market where you're going to need to understand, how is the market reacting? That's the tell. It's not necessarily the news itself. It's how is the market responding to this? So we are seeing a bit of a tentative move back into the tech sector. We'll see if it holds. And John Zechner tells us he's going there, not into some of the safe plays and some of the most beaten up ones. So I can't wait for you to hear this episode.
And if you want to keep up with the daily market action, I write a newsletter every single day that lays it out really clearly. Go to our website, inthemoneypod.com, and smash that subscribe button. You'll get it straight to your inbox, and you'll also get pro picks. If you ever miss it or you don't remember what was said in pro picks, I lay it out very neatly. Twice a week, you also get that in your inbox. inthemoneypod.com, smash that subscribe button. Okay, let's get into this interview. John Zechner, thank you so much for returning to the podcast.
Happy to be here, Amber. Congrats on the how well the show was done.
Thank you. Well, thank you. I credit some of that to you because you were like our second or third guest when we were kind of this nothing show. So I really appreciate you joining us that first time and joining us now, because I really love talking to you. You have such experience, and I feel like all these market questions that I genuinely have, I love bouncing them off of you because we're in such a wild time. It always seems like we're in a wild time. But I want to know what you're doing. I want to first understand, like, what are you doing in the portfolio? And then maybe we can back into some of the news.
Yeah, I guess we're trying to cut out the noise to the degree you can, which is very difficult. So you have, short-term positions in position. Like before this current weekend, I sort of on Friday, I loaded up a few more oil stocks and lightened up in a few other areas, just thinking that a peace agreement probably won't happen. So you're playing that, but trying to turn that down a little bit. The bulk of the portfolio was still sort of looking out a little bit further, and that the fact that this will pass at some point, the political, the geopolitical, and we'll get back to economics. We'll get back to, what's the Fed doing next? What are corporate earnings doing, which we're getting into that a little bit more. And then factor that out, what are valuations like? Because no matter how you cut it, it was an expensive market that I think was over-owned and over-loved. You've taken a little of that off. You overshoot in either direction, but we came into the year probably 23 times forward earnings in the U.S. Now we're under 20 times, so it's not cheap, but it's a little bit better than it was. So just separating out all of that, trying to find the spots, and then look at the earnings, what sectors are doing better, and what pitfalls might be out there that you really want to avoid as well.
Well, let's take this piece by piece and maybe start with energy. That might seem like the biggest no-brainer. And yet, energy stocks had kind of been falling going into those negotiations. Now, of course, oil prices shot up when they fell through. But how do you think about the longer term? As you say, you got to think about, okay, there's this war, but also what happens, in a couple of months from now when maybe this is not the top of mind story. How do you think about owning the energy sector right now?
I think, Amber, you got to look at it, I think, more on a somewhat of a permanent change. It's almost like the way 9/11 changed flying, forever. It really has, air travel. And I think this is going to change the way people look at energy long term. And, I think security of supply is going to become more important. And you'll start to diversify a little bit more. And in that environment, I think Canada, it probably is going to end up looking pretty good because in terms of geopolitical risks, reserves, given the oil sands and everything else, that's going to be a bigger factor, I think, for investments. And all we've seen is money going out of this sector for, over a decade now. And I think you might reverse some of that to some degree. So I think for Canada, it looks pretty good. So I want to position accordingly. So energy infrastructure, I think, is going to look better here, given where some of the spending is going to be going. And I just think the valuations will start to improve, particularly when you look at some of the, the long-term assets of, Cenovus and Canadian Natural Resources, Suncor, the guys who have these big, long, huge reserves that they've already done all their capital spending on, and now they're just operations effectively.
You're not known for hyperbole. So I think that's like a really big statement to say that this is on level of a 9/11 type of event in terms of how much it affects investor psychology and how they think about risk. And it sounds like you're saying this is a much bigger deal. We've had a geopolitical shock recently in 2022 when Russia invaded Ukraine. And eventually the market sorted through that and oil prices fell back down a couple years later to 60. It sounds like you're saying this is different.
Well, I think the investing world was not maybe fully aware of how important the Strait of Hormuz was to the transport of oil. And the problems in the Middle East, no matter how you cut it, they're not going away for a long, long time. You're talking about factions that have been at war for centuries. You're not going to solve these things very quickly. So the security of supply from that area, people are starting to realize how absolutely huge it is, how important it is to diversify away from that. And, that will impact prices, I think, for a longer period of time. When you look at, 2022 and the Soviet invasion of Ukraine, you had some impact to fertilizers in a short period of time, not really to oil dramatically outside of, what it did to maybe Russian supplies. This seems like a bit of a totally different ball game, unless you get to total peace in the area, which to me, I'm a little skeptical that you can ever get that because it's been so, I can go back to, the 70s and Anwar Sadat and, settlements, nothing ever came of that effectively.
I mean, since the war broke out, oil prices are up 43%. And I'm looking at Canadian energy producers, only up 7%. U.S. energy producers are flat. So do you think that energy investors are mispricing the risk? Like, why aren't we seeing a rip your face off rally in energy stocks?
Well, I think it's not a full belief that energy prices or oil prices will hold, anywhere close to these levels. And I think that's, maybe a little misguided because I think in the end, we are not going back to $60 to $65 a barrel, which a lot of these stocks were priced for. I mean, we saw it last year, in fact, where you started to break $60 level and OPEC Plus was having some issues with supply and starting to put it back onto the market and the demand was going down. Everyone was worried and, stocks priced accordingly. And then they started rallying since. But yeah, when you look at these stocks and their valuations longer term, they still look cheap to me. And I think, ultimately oil settles $70, $80 a barrel. I'm looking at the long-term contracts right now or the shape of the oil curve. It's certainly in contango right now, but, that's not going to last. And I think,
which means it's like cheaper.
Cheaper, further out. But, what are you pricing out 6 months to a year? It's certainly higher than it was before. So.
What does that look like in the portfolio? How loaded up on energy are you compared to what you've been in the last couple of years?
Yeah, we're still probably a little bit underweight. It's still a pretty heavy weight. I'd say we're into the mid-teens of an equity portfolio right now, and some of that is in infrastructure. Pipeline stocks we still own. Probably the weaker area in the short term that we're not in as much as natural gas. That's still under pressure. I mean, Canada is not benefiting from what we're seeing in terms of natural gas prices in Europe and elsewhere because we just can't transport it there. So until, we get more LNG, another pipeline, and that's going to take years and years, Canadian gas is still going to be subject to oversupply conditions. And I think the bulk of, the Canadian nat gas producers are, still subject to that. So we, as an example, we sold our position in ARC Resources that ran up because it's still, very highly levered to gas, took down Tourmaline, names like that, and sort of switched to Canadian natural Cenovus, white cap guys who are pure oil producers.
And so talk to me about why, even though you're bulled up on energy, you don't want to, your advice to investors is not to take it to 50% of your portfolio. Like what keeps you relatively underweight? If you have such a bullish case, why not have a bigger exposure?
Well, I just want to participate. I don't know where it's going to go in the short term because you easily could have this peace could break out or the risks subside in the short term and you do get some selling pressure. And we saw that last week when you had this brief ceasefire or whatever it's going to be and how hard oil stocks got hit in the short term. So on a trading basis, they've had a really, really good run. So I want to have, a bit of a hand in the game, but I don't want to sort of have the full position there. And there's other things that are going to look interesting in the market too. But I think a lot of people have been, avoiding oil for the last couple of years. I mean, Amber, you talked to a lot of these people. Yeah. And, a year ago, or I don't think you got a lot of people coming in and say, I really want to up my oil exposure because it was looking more like it was heading down into the low 50s rather than any other direction. So I just think, don't be out of the sector, but, have something in it. Yeah, I'm doing the same thing with gold as well. I mean, there's some things that when they have great runs, you don't want to sort of be the last guy in the game holding on to the biggest position, but you still want to participate. It still be maybe more upside.
So what have you been doing with gold trimming?
we had trimmed, and now I'm more inclined to be a buyer on some of the weakness, because again, these things a lot of them have pulled back a long way, and they're still really, really cheap. And I think the fundamental story in gold is still intact. Like in the short term, the U.S. dollar during this war has reachieved or put back its position as a global reserve currency. That's it. In the times of safety, stick in the U.S. short-term treasuries or whatever, that is the safest spot. No other currency has replaced it. Gold to some degree had for a while, but when people want safety and liquidity, the U.S. dollar is it. So the U.S. dollar rallied in the past month and a little bit. So the areas that had benefited from that weakness in the U.S. dollar suffered quickly, like gold, and markets move very quickly. But I think ultimately, when you look at what central banks are going to be doing, they're going to be diversifying away from the U.S. dollar over longer periods of time. Too many assets. There are things like U.S. Treasuries. U.S. is now the biggest debtor in the world. I mean, you've talked to a lot of people lately are sort of laying out what the debt situation is, and I just think the U.S. dollar will slowly give up its global reserve currency. But in the short term, when you get crises like this, it still has that cachet. But, it took a long time. You go back almost a century when Britain, the pound, was the global reserve currency, and Britain was, effectively the strongest industrial economy in the world. The pound remained a reserve currency a lot longer than Britain remained a powerful economy.
Interesting.
I think the U.S. is giving up that position as the most powerful economy slowly, and we're seeing it, because of what's happening, in China in particular. They could hang on to that reserve currency for a while, but it's headed in the other direction. And as it is, central banks will diversify, and you're seeing it. They will add, other currencies, but no other currency fits the bill yet. So in the interim, put in some gold, and that's what they're doing. And I think that will continue. And in the meantime, the stocks are trading some of the below net asset value, 4 times operating cash flow, things like that. They're not reflecting $4,500 or $5,000 gold. I think they're reflecting, $33,000 to $3,500 gold.
What's your favorite name?
I would roll with, take geopolitical risk out of the equation is what you want to do. Torex sticks out as a top name for me, TXG, and because it's got this giant Mexican property, Morales. So I don't see Mexico as a geopolitical risk outside of, the Sinaloa, the cartels and stuff like that, and some of the problems they can do. But these guys have taken their main underground, or the main open pit. The El Lehman property was sort of hitting the end of its useful life. And when that happens, people price these stocks right down. So it was basically trading at 3 times operating cash flow and a huge discount to net asset value when gold was at, $2,000 to $2,500 an ounce. In the past year, they've managed to migrate to, there's another property or another mine on the same property called Media Luna. They brought Media Luna online and basically replaced all the El Limon production. So they're back to running 400,000 plus annual in gold production. And at the same time, they've gone underground at both Media Luna and El Limon and extended the reserves. Now they've got sort of into the reserves are out into the mid 1930s. So you're getting, or 2030s, I'm a century out. And so now you're getting, a safer gold production over a longer period of time at a sort of the minimum of 400,000 ounce production, biggest producer in Mexico, trading at basically under 4 times operating cash flow.
I mean, it's lagged massively.
If you're NAV, it's cheap. It is so cheap.
If you're looking for a player that didn't participate as much in the gold rally, Torex has lagged. So you think it's being excessively penalized?
It is, and what I've gotten out of it is some of the international plays. I mean, we had been in B2 Gold and places like that, and you realize no. Mali, the geopolitical risks, they were real. And I think as well, the higher gold prices go, the more the geopolitical risks are important, because to those governments, when gold's suddenly at $5,000 an ounce, you're leaving more on the table by not participating in it. And you know what this can do? I mean, look at what happened, on copper with First Quantum in Panama and Cobre Panama. Is when they want a piece of the action, it changes the nature and the valuations in a huge way.
You don't see that risk in Mexico.
I don't see that risk in Mexico. I see it in West Africa in a huge way, though.
The market bottomed March 30th. And I think what's interesting about that is what has led since that bottom? For the past year, we've had many guests come on saying energy is underowned. It's not consensus. That's served our audience really well. And now I wonder if being long energy has become consensus and beating up on tech has become consensus, because from that March 30th low, energy is the only sector that's down. I'm talking about the US markets.
Yeah.
And tech is the best performing sector. I wonder if the punishment has been doled out in the tech sector enough in your estimation.
It's getting there, Amber. I mean, you can always overshoot on the downside, but you've taken some of the premium valuation risk out of the equation, and you've taken some of the other risk out in terms of the free cash flow and others going forward. And quite honestly, and I think we'll start to see this in the next couple of weeks in the earnings season. I think when earnings start to be reported, what you're going to see is the best earnings growth is still coming from the technology sector. The spending on AI at the rollout, as that will continue on. I think the only thing is you sort of, want to get the soldiers right, get the horses right within that and see what the shifts are. And the big laggards over the past 6 months clearly have been the software companies. And there's a lot of negative views there. What was interesting when the war started and people were looking for safe havens, if you look at the IGV versus the SMH, like the software versus the semis over the month of March, or certainly in the early, I think that was one of the strongest periods of outperformance for the software stocks you'd ever seen versus semis. That seems almost counterintuitive. Why did it happen? I think some of these software stocks, the valuations have gotten so low that they are effectively becoming a safe haven. Low valuations, and maybe the earnings growth risk is not as great as some of the people are fearing. Then they got hit again last week, and semi started to rally, but I think that was almost totally due to Anthropic.
Yeah.
They came out when they started saying, okay, Anthropic's got basically a $30 billion ARR, an annual revenue run rate, versus, maybe a couple of $1 billion a year ago. Okay, if they're annualizing $30 billion in sales right now, who are they taking it from? Or is it growth of the industry overall? I think, they're probably taking some of it from the application software layer, but I think some of it is growth overall. So the market seems to be assuming it's all coming out of software, because you look at it, Adobe, what are we, 10, 11 times forward earnings, Salesforce, 12 times forward earnings, Workday, ServiceNow, all of these guys.
I mean, are you brave enough to go there?
Oh, absolutely. Yeah.
Which one? I know you brought us another punching bag in your pro pick, so don't tell us about that one, but which one are you brave enough to go?
Well, a couple of them, yeah.
Okay, tell me which one.
Adobe, like I say, Adobe, I know what the risks are at Acrobat and all of that. And, my daughter is actually, she's a digital media. She did her graduate work there, and she works for a company doing the website and all of that, and they still use Acrobat to a large degree, and they will for a period of time. And these guys have an ability to sort of migrate themselves into these positions and continued use. You're not going to get rid of these application software layers completely. I mean, I do our software, I do our payroll. Where do I do it? ADP. Am I going to change that? Not a chance. Are you going to change TurboTax for doing your tax input? I'm not going to say to Gemini, do my taxes for me, please. You got all these layers, so they will continue on. Salesforce, I don't know how well Agentforce will do, but you can incorporate that going forward these guys can exploit the growth in AI, I think, as well as anybody out there. Shopify can incorporate it, and it's not cheap stock still, but it's got hit pretty hard, recently, despite, 30% growth rate. So I see names like that, Constellation Software up here. I think some of this.
You're going all into these names.
Well,
this is the eye of the storm.
Well, I'm not, Amber, I will never roll the dice totally on a sector and go crazy. But I mean, there's lots of names that are looking cheap. I'm not going to try to own them all, but certainly you get stocks that are still growing double digits, that are trading at 10, 12, 14 earnings multiples, unless their business is completely being demolished. I mean, they can, create value in there. And everyone, maybe it's a value trap, but I don't, let's see what the next couple of quarters look like. I'm certainly, not taking a high degree of risk by buying them at these levels.
What does discipline look like in the portfolio if you are going to buy these companies? in terms of maybe the exposure that you have, how long you have to be patient? Is this a trade you expect to work like in the next month or two? Or do you think, I'm probably going to have to hold on for a couple of years, let all of this shake out?
Yeah, I'm not, I've been doing this for a long time. I'm pretty patient. And, I'm a marathon runner. I'm sort of used to pain and enduring it and all of that. So I can live with it, and I've had that before where stocks have turned down for a while. And lots of times I've kicked myself afterwards where you finally end up selling them and then they end up rising for the exact reason you own them all along. So what you got to look at to me, Amber, is the story. Is the story deteriorating? I look at the next couple of quarters, and if I start to see, negative revenue growth or a huge deceleration in sales at Adobe, at Salesforce, if Constellation can't continue to do acquisitions, or if their organic growth goes negative, or Shopify slows down dramatically, I'll start to rethink those positions and all of that. But I don't think it's there right now. I think the bigger risk is on the other side of the equation where things have done better, which is, the data center spending rollout and the chip stocks. I think those, to me, are more where the valuations are still higher and the expectations are high, and investors believe this will go on ad infinitum. And it won't. It will slow down at a point, then you're going to turn around and you realize, no, maybe there was a little bit of double ordering on some of these chips. Margins aren't sustainable at the levels they are. On software, margins, they will come down a little bit too, but I think they will still hold relatively strong because your investment cycle is in front of that, and then pricing is not going to change too much.
So you're almost more cautious on the semis, which have done well, and you're taking a hard look at some of those beaten up software names.
Yeah, we've taken right out of the semis. We've sold NVIDIA now, and I've taken all of those names off the table. Long ago, got out of Celestica and names like that. Just the valuation. I don't think data center spending is going to continue at the rate it was. Okay, it's surprising how strong it's been. I shouldn't say that. I'll get to one later on that is probably a little bit more on the data spending side, but it's cheap enough and it's come down a long way. So,
one of the extensions of this conversation in software has been, to what extent are we re-rating the value of these companies? And it started to infect private equity, private credit companies, particularly in the US. And I wonder, so if you're willing to buy beaten up software names, are you willing to buy beaten up private equity names like Apollo, like Blackstone, which have been tarred with that uncertainty of what's going to happen with software? Is AI going to disrupt their business?
I have not gone into any of those names as of yet. I mean, you look at them and all of that, but I've was sort of negative. This is such an opaque area, and it continues to be that way. And I think they've made a very, I won't call it fatal, but a really huge error all along. I mean, what made private equity and private debt work for years is a type of investors. It was these large institutions that could hold these positions forever. And they weren't impacted by quarterly moves, so they could do that. Then when they eventually rolled them out, they had massive increases in value, multiple times. And we'd seen that with the KKRs and everybody else. They did that exceptionally well. Then I don't know what it was. The banks, they all started getting a little bit greedy, and there's not enough to have these big institutions investing in it. We need the everyday investor who's sort of going into the markets generally. We want them investing here too. And they don't have that patience. They don't understand the liquidity issues to the same degree. And they all rush in, and now they're all trying to rush out. And, Blue Owl was the litmus test for that. And that's, why you've seen under some pressure. So I think this is far from over. In fact, this morning, when Goldman reported, their earnings, I mean, that's one of the big red flags why the stock they had great numbers, but it was down in aftermarket just because, the hits they're going to be taking on some of these holdings in private equity and others is much bigger than expected.
Their fixed income division was certainly a problem. So it's interesting that, the market chose to focus on that. A lot of these companies, these asset managers, we'll talk about the banks because they're related but separate, but the asset managers, how do they make their money? On a fee of the assets that they manage. And I was reading a note, I think it was RBC's Greg Party, who said in 2020, the loans to these from non-bank financials was $695 billion. And today it's $1.9 trillion. And how did they do that? They got, retail involved. They got more cash. Party was making the example, when you get that kind of growth, in anything, you're bound to have maybe made some mistakes in what you're underwriting. So it sounds like you're saying you don't think we've seen the last of maybe the cockroaches to come out of this sector.
It always surprises me how far these things go in either direction, on the upside and the downside. And, I think, you've seen some damage on the downside so far, but I haven't seen enough to say, okay, the problems are over. They're getting all the funding they need in private equity. And plus, I don't really know what the valuations are because I still don't know exactly what they own. And, and you're seeing in other areas of market. I mean, up here, look at, Propel or Go Easy or guys like that.
Not Propel, they would tell you. It's only Go Easy.
Yeah, and it just, they've, who knows what really behind some of these, higher risk loans that are less liquid or all. You don't know it's the whole thing until, the tide rolls out that they're, thing about the king has no clothes or whatever.
So what's interesting is you have the asset managers like KKR and Blackstone and Apollo. And then you have the banks. And so the banks arguably didn't participate as much, right? Because all this lending was happening outside of financial institutions. But the banks do have exposure. Sometimes they lend to Apollo, or sometimes they lend to a company that Apollo has also lent to. How do you think about the exposure of the banking group? And we're going to get, as you mentioned, all of their earnings this week. Are you exposed to some of the U.S. banks? We'll talk about the Canadian banks as well.
Right now, I've got almost no bank exposure on either side of the border right now. And it was a combination of some of the things you just mentioned, as well as valuations where they sit. And the fact that some of the tailwinds for the financials, I think are disappearing to a large degree. Certainly, what they saw in capital markets. There's still a risk, for the bond trading, the bond portfolios as well, particularly now if interest rates are not going to fall as much as necessarily expected. So I just less of a fan. I find the other things that are more beaten up, the valuations are lower and that the earnings are not as risky. I mean, the banks generally on both sides of the border have had some massive tailwinds over the past couple of years. And I think some of those are disappearing right now. So
I read a note about the banks. Maybe we haven't seen, this was as it pertains to the Canadian banks, which as a group has been so robust. And it pertains to the Canadian banks, and asking the question about whether we've seen the worst of provisions for credit losses, right? Money that you have to set aside because of loans that go bad. And this note made reference of the fact that the banks have been adding to their performing provisions for 15 consecutive quarters. So they are kind of saving, some money, setting it aside, consistently setting money aside. And yet, the sector or the stocks seem to be behaving like maybe the worst of the credit events are behind us.
Yeah, I debate that number a little, or that commentary a little about the what they've been preserving, because when I looked at the numbers last quarter, and I just thought at the top of my head, I was looking, I think BMO was running around 30 basis points in loan loss provisions.
So their overall provisions, I think, have come down.
They're
this
very
was referencing
low,
performing provisions, which I don't know. Maybe that's just a nuance.
Yeah, I guess I look at the basket of performing, non-performing, what their expectations are. If they're not, they're still performing, maybe they're not going to be soon. But I think the only one who really took a hit was Scotia. They were around 60 basis points. But I think in troubled times, or in decent times, 30 to 40 basis points is probably okay and accurate. It's about as low as it's going to get. But when you get any risks to the economy, you've got to be providing more. And I think there's risks to the Canadian economy still. I mean, this USMCA, going up.
We haven't even talked about that.
Yeah. People are sort of assuming they'll get rewritten. I mean, I don't know. It could get put off totally. I mean, Trump doesn't care, and he's not a fan of Canada. We know that. We sort of put that off. I mean, you got to remember, a lot of our exports to the U.S. have been protected under USMCA, about 85% of that. If they don't renegotiate, but in July, if it's not, the agreement is not extended, suddenly a lot of sectors are going to be a lot more risk, in particularly autos and auto parts. And you don't have to look much beyond aluminum and steel to see what happens to these companies and these industries and the towns that support them when those tariffs actually go into place.
And we've seen it in regional areas where they haven't been isolated from tariff impact, like Windsor. What happens to
the Sioux,
unemployment?
Places
Sault Ste.
like
Marie,
that, and you can't, Ingersoll, a town like that, you can't cut 600 jobs in a town like Ingersoll and not have an overall economic impact on the town and the surrounding areas.
All right, we've already talked about a lot of stocks, but we've got a bunch more in the mailbag, so let's get into that. All right, our first question in the mailbag is actually on Fairfax. I think they have a annual general meeting this week. Thoughts on taking a position in Fairfax for the long term? This question coming from Rob on Instagram.
Yeah, I'm not a fan. Buy it if you think the insurance operations make it a decent buy. That's the sole reason buy. Don't buy it because you believe they're the great value investors for the long term and you're willing to pay a premium for that. Because, Prem has done a good job. He's made some great investments over a period of time. I don't know that's enough to sustain it. And I don't know how long that goes on. And you certainly just look at the, performance of Berkshire since Warren has stepped aside effectively, and nothing has really changed about the insurance operations, the assets they own. So I don't know. I'm more for playing things directly, for investing directly. If these guys are investing in those particular kinds of companies, well, maybe you should invest just in those companies. It's an insurance company. If you like insurance and you like the valuation of an insurance company, buy it. I don't see it.
It's so interesting you mentioned Berkshire because I think a lot of, Fairfax fan boys and girls will say, well, Fairfax is better. It has outperformed recently Berkshire. And it's interesting that you draw a parallel on what happened to Berkshire and extend it to what could happen with Fairfax. You think that there's a premium built in on Prem or his team's acuity on value investing that you're not necessarily willing to bet on?
Well, they're going from the same playbook, which is why I said to go the parallels, because it's the idea is you run an insurance operation and you're always going to have reserves on the book to fund the insurance operations. And, before Berkshire really became a big play, they mostly just sat on these things in treasuries and other safe investments. I think, Berkshire reinvented that by investing those into long-term assets that had great value and would grow and increase the value overall. And that gave a premium. And when you look at Fairfax, that's effectively the same playbook. There's an insurance operation. You use it to fund longer-term assets that if you can make great investments there, you can compound your returns to the benefit of shareholders. Like I say, it's the same playbook. That's all.
Okay, so you're not a fan there. We have another question on Cameco. Would John add Cameco now or wait for a pullback? This would be for a long-term hold. This question coming from Sterlias on Instagram.
I just think there are, they will always have a premium valuation, and they are the go-to global producer when people get bullish on uranium for all international investors, because nobody has a position like Cameco, and they're great operators and they got great reserves and everything else. I just choke a little on the valuation. I mean, you're still talking about a resource stock trading at 40 times earnings, close to 30 times operating cash flow. And, talk about I think there are cheaper ways to play the growth in nuclear expansion and uranium prices than directly through Cameco. Cameco will participate. I just find it a very expensive way to play that.
All right. We actually did an interview with the CEO of Cameco. So if you want to get smart on the company, you can check out our website in the Money Pod and look for that interview. And John does like uranium, so stay tuned because he's got another way to play that sector. Another question that we have in the mailbag is about the telco sector in general. First, Dylan calls you an absolute legend. Canadian telco thoughts. That's his full question. What do you think?
Yeah, well, to be a legend, you have to be old. So maybe that's more the line. But anyway, I appreciate it. Telcos are a tougher call lately. They've certainly been they've underperformed since like 2022. And a lot of that has been the slow in the population growth in Canada. Because let's face it, everybody's got a cell phone. If you can't increase the ARPU, you're not, the only going to do is subscriber growth, which you're going to get through immigration, new students, and all that. You don't have that. So that's slowed down. And
it's just average revenue per user. So if you can't charge people more, you got to get more subscribers in. And
then at the same time, in terms of that, what you've had is more price competition because you've got a legitimate fourth player, Freedom Mobile, owned by Quebecor, and they've probably been the better performer. So the industry growth has slowed down. Now, having said that, where you stand right now, I'm looking at companies that, do have long-term growth, trading about 6 times operating cash flow, generating pretty good free cash flow. In fact, what I would call, telecom is infrastructure assets, safe to such a large degree, domestic businesses, which I like. They're always going to face, competition, maybe, from satellites, although they can migrate that over to that a little bit. And, Starlink, people, groups like that may incur a little bit. But in the end, I think the valuations are attractive. But there's still some warts. I would, be careful of TELUS in the short term because I think they really need to cut the dividend. Maybe the stock's already pricing that, but, they need to get the balance sheet in better shape. They've got CapEx going forward. I think the best way to do that, especially with, Victor Dodig in there now, with new CEO is, it's the old kitchen sink in your first quarter, just take it. And I expect in the next quarter, they should be cutting the dividend.
Would you look at the stock after they cut the dividend?
Yeah. And we did that with BCE, and it really did hit the lows, I think around the time of the cutting of the dividend and all. It's expected. I mean, when a stock has a 10.5% yield, the market is telling you they expect a cut. But what surprised me a little with BCE and to tell us to a degree is there really are a lot of dividend-only funds in Canada, dividend-only players, and I probably underestimated how much selling you get from that group once you do get these cuts or, certainly a removal of the dividend. We're just going to get a cut, but, it still impacts the players. We saw that on the one that brought that to light to me late last year was Northland Power.
Yeah.
When they surprised and out of the blue, they cut that dividend in half and the stock dropped more than the value of the dividend cut so that the yield effectively stayed at the same level, post the cut. So.
Did you own Northland?
We bought it on the soul.
Dip.
Yeah.
So it's so interesting you say that about dividend cuts. It's been brought up on the show about that psychology and the fact that, Canada is such a land of dividend income-oriented investors. And that when you break that trajectory, that trust of consistently increasing dividends, those people don't really come back or they take a really long time to come back. Manulife is often used as an example of a stock that took a really, really, really long time to get back into investors' favor. Do you think that some of these dividend cutters could face that same sort of long haul?
They seem to have a long memory, and Manulife is a great example of that. I mean, for a variety of reasons, they had other issues, but when they cut their dividend, I mean, it took them from 2012. I think it, took them over 12 years to sort of get back
to where they were. Yeah,
exactly. So that is some memory, and it's just the cohort of income oriented investors out there because of the dividend tax credit in Canada, the age of investors and other things. A lot of them depend on this. I see questions that you got in your various positions over time about BC and all of that. It always seems to be about the dividend as opposed the growth and the operations or anything else. And you realize there's a lot who count on this, and you got to be wary of that, and you got to be wary of how sustainable are these dividends. What is their payout ratio?
Well, kind of in that exact vein, we have another question about the Canadian utilities, which, is definitely a favorite for income-oriented investors. But this question is actually about the growth. Which Canadian utilities do you think will outperform given increased demand for power? This coming from Amy Loves BC on Instagram.
The one that sticks out, although it's had a good run lately, we still own it as Capital Power. Mm-hmm. I just think the electrical companies in Canada, and especially given their expansion into sort of the Pennsylvania, Delaware corridor as well, as doing acquisition there, and they keep getting increased pricing. And I just think this whole data center build out is going to increase that demand and keep prices high. And Capital Power being mostly Alberta based, they again. they are well exposed to that, because I think Alberta is taking the right strategy. It's almost like Texas a little bit. Let's make ourselves a home for data centers. And we've got lots of energy. We've got lots of natural gas, electric power. You can locate here. We've got lots of land, and you can make it effectively, very economically beneficial for them to do that.
Now, have these companies talked about, you can definitely see, and it's already happened, a situation where power prices become politicized. The way grocery prices are politicized, the way that what you pay your cell phone becomes politicized. Data centers, if you're a politician, can't be seen to be driving up, the power prices for everyday people. Do you think that like a utility like Capital Power, they're going to face limits on their ability to enjoy pricing power?
Yeah, I don't think they have to, move the prices up that dramatically. I mean, they're getting growth from expansion, and they're getting firm prices and usage as well on top of that. So, they don't have to increase them dramatically. And I think, to a degree, governments are not going to control that pricing that aggressively. Maybe they'll subsidize it to some degree, and that's, a fiscal call as opposed to a corporate call. They can't afford to have these guys stop making those investments, because they're going to need that capacity going forward. On the other areas, sort of you mentioned, utilities and other areas, and they're not viewed as utilities as much, but I think the renewable energy is another spot that looks interesting. I briefly mentioned, Northland Power.
Yes.
We had Boralex, but then, Boralex recently got taken out. But they are utilities into really have large. They do the spending up front on CapEx, and then they tend to pay a lot of that out to shareholders over periods of time once the spending is done. So they tend to have, stronger dividend yields as well. So, and that's an area that I think in the current environment is going to have a little more attention paid to it. I mean, you sort of look at the biggest spender in that area over the past number of years has been China. Mm-hmm. And China, because of that, has insulated themselves a little bit more from this huge move up in oil prices compared to a lot of other places. On top of that, they were smart by refilling their strategic oil reserve, in front of this.
We have so since Boralex got bought, you scooped up some Northland. Is there another renewable play?
Well, I guess the play to look at then, the other sort of play is the Brookfield Renewables, because they effectively bought that. So I guess that would be another. I can't, off the top of my head, the valuation was a little bit higher than the rest of the group there, and I'm not sure what the dividend yields, but that fits into another play.
Okay, well, why don't I look? We can do that. We're a podcast. I can pause and look it up. So Brookfield Renewable, no dividend. Oh, sorry, I'm looking at the wrong
there's so many Brookfields. That's
there's
what I
so many. Brookfield Renewable Partners. The ticker is BEP, and that dividends 4.5%.
Yeah, that's sort of in line with those. Yeah.
Okay, our final question in the mailbag is around WSP. I was looking to add an engineering stock to my portfolio. Now that there's been modest pullback, I'm favoring WSP in my research, but ATRL is also on my radar, which is Atkins Realis. I would appreciate Mr. Zechner's view on this segment of the market and WSP in particular, this coming from Don in Vancouver. These names have been kind of run over a little bit, and I think there's a bit, if I'm not mistaken, a bit of an AI scare. To what extent will some of their consulting, are you going to use them to replace?
Yeah, and WSP had done well up to that point. I mean, the pullback it's had, and if you look at it on a longer term chart in that perspective, isn't that great. Same thing with Atkins Realis. But I guess if I were to choose one of those two, I'd take Atkins Realis, just because I think, the expansion in nuclear is more front and center for them with the CANDU reactors. I think the growth in that sector is higher for them. So I think that'll, give them a bigger part of their valuation and overall revenue and the growth over periods of time. So I'd probably take that one. Aecon has done well as a lot of these ones where they're benefiting obviously from the capital expenditures, going forward, the government spending. Another bit of a wild card one is North American Energy. Nobody really talks about it too much. They're the ones who used to, upgrade all of the oil sands operations in, Fort McMurray and all of that. But they've really diversified out over time and expanded into Australian construction assets as well, and trading about 3 to 4 times operating cash flow versus the rest of this group. So it's a, huge discount.
So not you're maybe looking at Atkins Realis, not interested in WSP right now.
We own Atkins Realis
You
and have
do?
for a period
Okay.
of time, continue to hold on to it. I haven't added to it recently, but I still like the story.
And what about AI threat? Do you think about that as a risk?
Not on this one particularly, because I just see right now there's a spending on capex, right, that's going to go forward, and a lot of these for Atkins is going to be based on their nuclear expansion. I think what I would be concerned a little bit more if the way reactors are built starts to change, if they move away from the can-do model. And you've heard of these mini reactors and things like that. Yeah, that if that starts to be more of a play, and I don't know exactly how well Atkins is positioned there, so that would probably be you more see. But I think this spending is going to occur, and I think it's what we've seen obviously in the oil markets recently is just telling people, no, we've got to diversify our energy sources a little bit more aggressively.
Okay, well, let's find out where your conviction lies and get into your pro picks.
Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information.
Okay, before we get into your new round of top ideas, I want to revisit the ones that you brought to us last year. January 24th was when you were on. You picked Cenovus, Maple Leaf Foods, and Uber. And most of them have done really well. You're up 75% on Cenovus. You're up 76% on Maple Leaf Foods over that time. You picked Cenovus at a time where that wasn't cool to do.
Yeah.
Oil prices were declining. Do you continue to own it?
Cenovus, yeah.
Yes.
We did. I sold some of it. I'm kicking myself a little. One of these, I wish I'd listened to my own advice at that point. So we didn't get the full ride of the thing. But yeah, I've come back to a little bit more recently because it just, it is the play in terms of, and the acquisition, at that point, they weren't even in the running to where Meg Energy
That's
wasn't.
right, yeah.
No one knew about it. You're going to look in retrospect, the timing of them buying Meg Energy was phenomenal. I mean, you got a huge asset with long life at a very cheap price, and now you can sort of bring it on board.
When you picked Maple Leaf Foods, it was languishing at the lowest level since 2022. And you said that this is a company they're restructuring. You're going to get margin improvement. Look for the spin out of their hog business, which they did. And what a rocket. That was a great call. And then there was some volatility. So I'm curious if you held on to it, if you continue to hold on to it.
Yeah, we still hold. I just laugh at that because you and Francis gave me a pretty hard time on that one. We were talking about the vegan food.
Yes, yeah, you're like, it's fine.
And I said, yeah, I still eat steak and all of that. Yeah, they spun off the pork business as well. So you got that in Canada Packers. So that was like another $4 or $5 on top of the move in Maple Leaf Foods. Now they're a little more focused. It's a cleaner operation. They're focusing a little bit more on margin. So the stock's had a good run. I'm a little bit more closer to the exit at this point. I think you've got some of that benefit. Now they're going to have to deal with, obviously, rising input prices. What's the growth going forward in some of these divisions? They are a little bit more, they are at risk as well, obviously, in the USMCA and, because they obviously exported to the US, the Maple Leaf products. So, yeah, I'm probably, it's not as much a long-term growth story. It was as a cheap alternative. And I think in Pro Picks, I might have another one that to talk about. So.
And we'll find out what that is. But first, I want to go over Uber because we get a lot of questions about this. It did well after you picked it, and then now it's back down to where it was. So you're up only about 2% if you bought it January 24th, which is when you were on. Do you still like it? I mean, you could argue it's very cheap.
It is. In fact, the story in some ways is better than it was a year ago because they're delivering financially. I mean, 20% EBIT growth, the penetration. It's just the worries. I mean, tech has sort of had some issues, particularly software-related companies. And I guess this is sort of looked at a little bit more because of autonomous driving. And obviously the worries people have on autonomous and what that will do to Uber. The idea that, the whole Tesla fleet of autonomous vehicles is going to, make Uber drivers irrelevant. And, I don't know. It's, Waymo will do the same thing. I think Uber can be part of this, and they've already sort of done it with, Waymo in some spots in terms of, being the booking agent and the delivery and everything like that. So, and obviously Uber can get into autonomous vehicles as well. I have never ridden an autonomous. Have you?
I have not, and only just because I want to download. I didn't want to download a separate app, but I think I would like it because I don't really like Ubers. I don't, the social.
Yeah.
I don't want to have to talk and just deal with it. So I think just because I'm antisocial right now. Jillian's laughing because we've looked at Uber scores.
Yeah.
Mine might not be the highest. I'm not rude. I just don't really want to talk. Okay. Anyway, I digress. Your new round of pro picks, always interesting, always unconventional. Your first one, I wonder if it's this year's Maple Leaf Foods. It's Premium Brands. It is trading. I don't think it's a 2-year low like a Maple Leaf Foods when you picked it, but it's trading around a 10, 11 month low. Food processing company. Yeah. What is the market not getting right about Premium Brands? Why now?
It's funny you say that, Amber. It's very similar to the Maple Leaf story in that I think it is underappreciated. And I think the other thing about these companies too, you like to buy them after they've done major capital expenditure because then they're starting to, get the benefits of that. And they've had a major CapEx spend over the past couple of years. They did an acquisition on top of that recently. So, their free cash flow has been a little decimated to a degree. It went negative for a period of time. So they got to start to pay down some of that debt. But at the same time, they're getting growth again from these operations. And their big thing is packaged protein products. They're obviously, and they're selling into the U.S. in large degree. But I just think that's, that is a very strong market going forward. Everybody's got the protein fixtures. I do the protein bars and all of that. I think that everybody's sort of very aware of that. I'm
constantly told, a woman of my age, I am not getting enough protein. It's and you know what they're coming out with? I was reading this week, PepsiCo, protein Doritos.
Oh, yeah.
So you don't have to feel guilty about your Doritos anymore.
Yeah, I stop at Tim's and you get a protein latte and things like that. But you've got young kids, Amber, as well. Like when you throw things into the lunchbox or whatever, what you want to give is something protein. That's exactly, and yet something that is has some shelf life. You can put in. They can have it later in the day or whatever. And I just think that, they are on the spot. You're getting it at the lowest relative valuation. I think 8 times forward cash flow than you have in a while, under 20 times earnings. The CapEx cycle is done with. They're going to start to harvest some of this free cash flow, pay down the debt. They've got some growth going forward at a low valuation. So it ticks off all those boxes, and it's sort of just a bit of a diversified area. I mean, there's still the risk. Obviously, any Canadian consumer products company right now is at risk, particularly one that sells a lot in the U.S. or what happens with USMCA. And you get in the crosshairs of that. But I just think, you're compensated for that to some degree.
So it's $80. A few months ago, it was over $100 stock. Does it get back there? Should it be higher as it reaps the benefits of these massive investments they've made?
Yeah, I think it should trade over 100. And like I say, we've been taking money out of Maple Leaf recently at a, sort of a 30 and plus, and putting it into Premium Brands, sort of into, I'd like to say only at these levels. I probably bought some higher up as well. So, but I like the story, and it's just interesting.
Okay, never one to shy away from being contrarian. This is the contrarian play, Oracle.
Yeah, you know what? And I have not been an Oracle fan. I was really, and we had owned it for a while, and I sold it last September, and then we got lucky on that one because it was up around $300, and I just thought, no, that
was the time to sell it.
But everything looked with glowing. Everyone was loving this. They just got the open AI agreement, and I think a forward contract of $350 million over a number. Billion, sorry.
Yeah.
Dropping these things in between here. But then the more you looked at it, the valuation at that point was over 40 times earnings. And I thought, okay, they got 5 years of negative free cash flow coming at them. That's, I don't like that. They're going to have to fund this. You look at what happened to the CD markets going forward for them a little bit.
This is the cost to insure against a credit default swap. Exactly. It's spiked on Oracle.
Exactly, yeah. And you saw that. And like I say, the negative free cash flow, you look at the quality of who they're buying from OpenAI. I didn't know, even if they're going to be around and all of that. I thought we got out of it, and I was really quite negative on the thing. But then the stock has just been hammered. It's dropped more than 50%. in the interim, they've gotten their CES. It's controlled a little bit now in terms of their forward financing. The last 2 quarters were actually quite strong. They're picking up in terms of the spending. They've beaten the expectations. The multiples come down. Now we're looking at around 20 times current year earnings, which is not bad. And I still think they probably are a legitimate fourth player in the cloud infrastructure market. You've got Amazon, you've got Google or Alphabet, and you've got Microsoft in there. I think these guys could line up as a strong player, and they may be the preeminent AI data center player as well. So I thought you're getting all of that at a very low multiple. And I just think, going forward, these guys have always...
Are you not worried about debt and their ability?
That's not that bad. I mean, they funded it going forward. And like I say, it's still going to be negative free cash flow for the next couple of years. That hasn't gone away. But we moved, a little closer to that. I think the sort of earnings profile is looking a lot better. And the other thing about Oracle is they've always been data center. Data was sort of what they sort of made their money on, corporate data management, effectively. And I just think when it gets to AI, everything is about your database, really. You get large language models, everything is about that data. And I thought, they've got that already. They've got that with their corporate customers. So I think it's going to be very easy for a lot of the corporate customers to migrate further into the Oracle sphere. And in terms of what they do with the build out on the data centers. So it's, all of that at this multiple, I still own Alphabet, and I still, we have added to Microsoft recently as well, and Amazon. So I've got all the cloud players, but these guys could be the legitimate fourth player in cloud.
What about exposure to OpenAI? Is that a risk?
Absolutely, it is. And it, more so lately, I think, because you sort of wonder, is OpenAI losing a little bit to Anthropic? With Claude. And as well, Gemini has proven a much stronger product. I mean, I don't know what you do, the AI exposure.
I'm using them all. I find they all have different personalities, and I use them for different things.
You can. I will go to Gemini before I go to ChatGPT, but that's just a personal thing. Yeah. It's similar models.
You're talking your book because you own Alphabet, so you got to make it work.
My ownership is not going to make a difference.
Are you looking? I mean, we're going to get some IPOs. Do you think you'd buy any of these?
Oh, I don't generally play the IPO market. That's a bit of a jaded game. Back in the 90s and when we were running massive assets and all of this, and I was sort of a bit more of an asset player, I'd say, because of the size. You could sort of get in and make and get positions in these things just because of the amount of trading you did. But in the end, if it's a really good issue, you're not going to get much of it. So what's the point? So I'd rather watch the trade, and I tend to watch the technicals more, and I'd rather watch the trading action on it and then to see what the valuations are. But the valuations, and that's the other thing, you talked about private equity and other things lately, more of that is accruing to those guys than it is to the public markets. Yeah. When they bring out, they bring them out at a high valuation. The whole thing, there's not much left on the table for the public investors. Yeah, sometimes you get a day one pop. And you've seen it on, the core weaves of the world and stuff like that. But a lot of times that just erodes later out, especially once the insiders are able to start doing, free to sell their own stock.
Okay, so you're going to wait to see how those play out. Your final pick, you're not bullish on, you're bullish on uranium. You prefer not to play it through Cameco because it's expensive. So you've brought an ETF, the Sprott Physical Uranium Trust. Why this exposure? Why is this the best expression of nuclear ambitions?
You know what? I would just rather play the commodity directly. I mean, I don't think of people looking really closely at the uranium market and the way it's acted over the past, number of decades. I mean, you look at it, and this was the old Uranium Participation Corp, and it is and I don't usually like playing, single commodity plays, and this is it. It's just an ETF, effectively directly on the price of the uranium, and it'll trade right in line with it. But you look at uranium, production has not been close to annual demand for decades because there's been so much excess supply in the market. You can start it from the end of the Cold War when everybody started de-enriching uranium, and they sort of took it out, out of their nuclear weapons, and they put it onto the market. So you had lots of excess supply there. Then Fukushima came along, and then you got a lot of companies like, countries like Germany and Japan and all of that got right out. So all of their inventory. So you've had excess inventories for a long, long period of time. That's slowly starting to wind down. At the same time, your annual production is nowhere near what your annual demand is. So I just think as the inventories disappear, bottom line, if this nuclear story is right, and I think it is, and you're going to get this expansion, when you look what's on the table, I was reading just this morning, Japan's got permits to restart every single one of their nuclear reactors. Germany realized the biggest mistake was shutting down those reactors. They want to open it up. China, the expansion is massive. So the demand will be growing. Where's the supply to meet? When these utilities actually start to realize that we got to lock up uranium supply, I can guarantee you, Amber, $85 a pound is not going to do the trick, which is where you are right now. You can't bring anything on new. You look at who produces. Cameco is the world's largest producer, and we certainly dominate it. A lot of the other production comes like Kyrgyzstan, because Uzbekistan, places like that. It's not, politically, geopolitical risks there and other things. And I look at it, you want to bring on more supply.
You need higher prices.
You need higher prices to do it. And this is a direct way to play it. So it in some ways, it's a simple story that's been unfolding for a very, very long time. And this brought physical, uranium trust. All they own is uranium. And, they've been buying more in the downturn. I just think the utilities have not stepped up yet to do the buying. And everyone says, it's the last thing they need. Well, that's true. You got to build the reactors. You do a lot of stuff. In the end, the last thing you need is, like your party. You need the supply for a lot of things. And this is the supplies to run it. But at a point, they're going to need it. At a point, they're going to start to try to lock it up. And I just think that, the supplies are not necessarily going to be there, or they're not going to be there at this current price.
All right. Always so fascinating. Thank you so much, John, for joining us.
Hey, always happy to join you, Amber. It's great, and congrats again on the success of this podcast.
Thank you so much. That's John Zechner joining us of Zechner Associates. Don't miss our next guest. We've got Tyler Rosenlicht of Cohen & Steers. He runs an infrastructure fund and he runs a natural resource fund. So we're going to keep this conversation about commodities going. If you've got questions, you can email us questions@inthemoneypod.com, and we'll catch you on the next episode.